The story of the 2008 financial collapse has often been simplified into a tale of greedy bankers, reckless homeowners, and a housing bubble that popped. But the real truth is much deeper, far more complex, and carries lessons that continue to shape our world today. This was not just a crash, it was a systemic breakdown of trust, regulation, and global financial architecture. In this video, we'll take you behind the headlines to reveal the untold story of how the collapse unfolded, why it shook the foundations of the global economy, and how its effects still ripple through our lives. The roots of the bubble. To understand the collapse, we must start in the early 2000s. After the dot-com crash of 2000 and the September 11th attacks in 2001, the US Federal Reserve slashed interest rates to historic lows. Money became cheap and borrowing skyrocketed. Americans rushed into homeownership, encouraged by the belief that housing prices never went down. Banks, mortgage lenders, and Wall Street firms saw a golden opportunity. They began writing loans to almost anyone who wanted a home, even if that person had no job, poor credit, or no steady income. These became known as subprime mortgages. At first, it seemed like a win-win. People bought homes they never thought they could afford. Banks collected fees. Investors on Wall Street packaged these risky mortgages into financial products called mortgage-backed securities, which were then sold around the globe. As long as housing prices kept rising, everyone was making money. But this apparent prosperity was a dangerous illusion. Wall Street's alchemy. The most untold part of the story lies in how Wall Street turned bad mortgages into gold. Banks bundled thousands of mortgages together, mixing good loans with toxic ones, and sold them as safe investments. Credit rating agencies like Moody's and Standard & Poor's gave these securities top ratings, labeling them AAA, the same level as US government bonds. Pension funds, insurance companies, and investors worldwide bought them up, believing they were risk-free. Behind the scenes, a web of even riskier bets was forming. Wall Street firms created a type of financial product called collateralized debt obligations, CDOs. These were essentially mortgage bundles, layer upon layer of risk disguised as stability. On top of that, a massive unregulated insurance market called credit default swaps emerged, allowing traders to bet on whether these loans would fail. It was a house of cards built on greed, complexity, and the blind belief that housing prices could only go up. The role of deregulation. Another untold angle is how decades of deregulation fueled the collapse. The repeal of the Glass-Steagall Act in 1999 removed the barriers between traditional banks and investment banks. Suddenly, banks could gamble with depositors' money, and they did, on a massive scale. Meanwhile, the Commodity Futures Modernization Act of 2000 exempted derivatives like credit default swaps from regulation altogether. This created a shadow market of trillions of dollars with no oversight. The financial system was flying blind, but nobody wanted to slow it down because profits were astronomical. The global web of risk. What many don't realize is how global the crisis was before it even exploded. European banks, Asian sovereign funds, and institutions across the globe were deeply tied to American housing. They had invested heavily in mortgage-backed securities, chasing high yields. In effect, the American housing market had become the backbone of global finance. When cracks began to appear, the contagion spread worldwide. By 2006, US housing prices had peaked. Suddenly, borrowers with subprime mortgages found themselves unable to make payments as adjustable interest rates reset higher. Defaults began to climb, foreclosures rose. At first, Wall Street brushed it off as contained, but the reality was that the system was rotten at its core. Once housing prices stopped rising, the entire chain reaction began to unravel. Families lost homes, neighborhoods collapsed, and the American dream turned into a nightmare for millions. But the damage went far beyond homeowners. The toxic securities tied to these mortgages began losing value rapidly. Banks stopped trusting each other, unsure who was holding how much toxic debt. The lifeblood of global finance, trust, evaporated almost overnight. The collapse of giants. 2008 was the year the crisis exploded. Bear Stearns, a major Wall Street investment bank, collapsed in March, rescued only by an emergency sale to JP Chase. In September, Lehman Brothers filed for bankruptcy, the largest in US history. Merrill Lynch, another giant, was sold off in a fire sale to Bank of America. Washington Mutual, one of the nation's biggest savings banks, also went under. AIG, the world's largest insurer, had made enormous bets on credit default swaps and required a $182 billion government bailout to avoid total failure. It was chaos. Banks collapsing, stock markets plunging, and ordinary people watching their life savings evaporate. The shockwaves rippled worldwide. Iceland's entire banking system collapsed. Europe entered a deep recession. Developing countries saw exports and investments dry up. It was not just a US problem, it was a global financial earthquake. Numbers don't capture the full story. The untold tragedy lies in the human cost. Millions of Americans lost their homes. Foreclosures spread like wildfire. Entire neighborhoods were abandoned. Families were forced to move into cars, shelters, or with relatives. Unemployment skyrocketed. College graduates entered the worst job market in decades. Retirement savings were wiped out. The crisis widened inequality as ordinary people paid the price while many Wall Street executives kept their bonuses. The government response. Faced with economic collapse, the U.S. government intervened. The Bush administration, followed by the Obama administration, approved massive bailouts under the Troubled Asset Relief Program, injecting hundreds of billions into banks to stabilize the system. The Federal Reserve slashed interest rates to zero and launched quantitative easing, printing money to buy financial assets and restore confidence. Critics argued this saved Wall Street more than Main Street. Banks recovered relatively quickly, but average families faced years of pain. The untold consequences. The untold story is not just what happened during the collapse, but what followed. The crisis reshaped politics, economics, and society. In the US, it fueled populist anger on both the left and the right. Movements like Occupy Wall Street emerged, demanding accountability for the 1%. At the same time, distrust in government and institutions grew, paving the way for political shocks in the following decade. Globally, the crisis altered power balances. China, less affected due to its closed financial system, emerged stronger. Europe, however, faced years of debt crises, with countries like Greece nearly defaulting. The crisis planted seeds of economic nationalism and skepticism about globalization that still echo today. Lessons ignored? So what lessons did we learn? Regulators did introduce reforms, such as the Dodd-Frank Act in 2010, aimed at increasing oversight of banks and reducing risky practices. But critics argue that the underlying issues, greed, complexity, and excessive risk, never truly went away. Today, global debt levels are even higher than before 2008. Shadow banking has grown, and financial markets remain highly dependent on cheap money from central banks. In many ways, the system was patched up, but not fundamentally fixed. Could it happen again? One of the most chilling parts of the untold story is the possibility of history repeating itself. The exact circumstances may differ. Maybe the next collapse will come from corporate debt, student loans, or another financial bubble, but the same forces are still at play. As long as financial institutions chase short-term profit and governments fail to rein in excess, the risk remains. The 2008 crisis was not an isolated event, it was a warning shot. The 2008 financial collapse was more than a market crash. It was a story of human ambition, systemic failure, and the fragility of trust in the financial system. It showed us how interconnected the world has become and how quickly prosperity can turn into catastrophe. The untold story is that while the names may change, Lehman Brothers then, another institution tomorrow, the forces of greed, deregulation, and blind optimism remain alive. The collapse was not just history, it was a mirror, reflecting the vulnerabilities of our present and the dangers of our future. And as we look back, one haunting question remains. Have we truly learned from the untold story of 2008, or are we simply waiting for the next financial earthquake to strike? What do you think? Have we learned from 2008, or are we repeating history? Share your thoughts in the comments, hit like, and subscribe for more eye-opening stories. Stay tuned. More untold truths are coming soon.